Welcome back. It's a global equity market sell-off. So in the Asian markets, it was led by China as well as Hang Seng with cuts of about 3 to 4%. Europe has taken it forward. The CAC and the DAX, as we speak, are down anywhere between 1.5 to 2%, and it's weighing on our equity markets as well. But I suspect it's putting pressure on metals as well. So to talk about commodity space and what's happening, we're now joined by Manisha Gupta. Manisha, it's over to you.
Thank you so much for that. Well, yes, the sell-off in commodities is basically coming in from the sell-off in equities, where you have seen, even as the dollar index is trading around those 2-year lows, but the US and China trade tensions is one part of it, and the markets still are awaiting further stimulus measures from US. So, well, yes, we have seen a huge run-up from the March lows, but at this point in time, it really seems to be getting slightly cautious and neutral, so as to say, for the crude and the metal prices. But Peter McQuire of Exim Australia now joins us to talk further about that. Peter, hi. It has been quite a roller coaster when it comes to crude or metals or gold for that matter. But I really want to begin with the base metal prices, because last night was a great gain, because we saw 4.5% up in case of nickel prices. This is after the Tesla boss said that nickel is what they're looking at to get into in longer term contracts. Nickel also is a very desired metal for the electrical vehicles, and that put the prices higher by 4.5%. But today, including nickel, whether it's copper, aluminum, where we also are looking at stronger fundamentals, almost everything has seen a decline. How do you read these markets on a day-to-day basis? And for a slightly longer term, what is your sense on this sector?
Well, good morning or good afternoon, Manisha. How do I read them? Yes, there's no doubt. I mean, if you look at it from an industrial demand and what Elon Musk's views are and what he's trying to achieve, and that new plant opening up, or where he's got it forecast to be outside of Austin, Texas, the demand picture is going to be quite extraordinary. So you take on board from an industrial demand side, yes, it's going to be stronger over the rest of the decade. That's unquestionable. It's just the volatility in the market is very much dictated as far as equity markets and I think general sentiment. And it seems to be a little bit of a washout today. Let's see what happens in New York tonight. But there's certainly an undercurrent of uncertainty with President Trump and what's happening with China at the moment. That certainly is not backing off, and seems to be an hour-to-hour proposition.
So, Peter, even with, as you said, even with a bit of a washout of a session that today has been, the metal prices are headed for yet another weekly gain, 9th in a row actually, because it has been quite strong there, whether it has been stimulus measures, strong demand recovery coming in from China, and those supply disruptions that we keep talking about with various mines as well. So, while this week is positive, how do you look at the near term? Would you be making use of this decline? Are you going to be on a buy side for any of these metals?
I think what you've got to understand, Manisha, is that we've had just an enormous run-up over the last 3 to 4 months since that last week of March. So that's unquestionable, and a rising tide has taken all boats. So we've seen that general push-up as far as some of those base metals, but they're still off, they're highs. You've still got, we're nowhere near the $10,000 a metric tonne for copper. We're nowhere near $30,000 and $40,000 or $50,000 a metric tonne for nickel. So they've got a long way to go to get back to those sort of prices. And we also know that the Chinese demand has been relatively strong. But is that going to remain? And what about the coronavirus cases? Is that starting to ratchet up again, second and third waves and significant lockdowns? And what impact is that going to have from a demand destruction perspective, with general uncertainty affecting the market? So no one's got this playbook. This one hasn't been written before, Manisha. So we're sailing into the second half of this year with a great degree of uncertainty and a US election within 100 days.
Well, yes. And how do you see that impacting the gold prices? Because that is one of the uncertainties that the gold is also factoring in, apart from low interest rates and easy money into the markets and a lot of uncertainty because of the economic recovery. What is your target now for the second half of gold?
I think the second half will take out the all-time highs. If we're talking, British pound, Japanese yen, euro, all at all-time highs. The only one that's not on an all-time high that's a major currency is US dollar. In rupee, we're at all-time highs. So there's very strong demand. and that's not going away. We understand if there is no vaccine, it'll be over $2,000, I'd say, probably by September. And if there is a vaccine, then how on earth, and I say this humbly, I'm not a doctor, but there's 7.5 billion people approximately in the world. That's a lot of nurses and a lot of doctors giving a lot of injections. How long does that take to wash through a market? And then you're looking at the trade-off. If we don't see any form of vaccination and we see continued increases as far as coronavirus, Manisha, then I don't know. Can it be 2,200 by the end of the year? We know what the situation is as far as inflation. We understand with cheap money, kicking the can down the road, there's a lot of nervousness. And where does President Trump play with trade and with China and coronavirus?
So one final quick question, and Peter, even as there is uncertainty there, and you said gold is a definite buy there, even for metals and crude for that matter, you don't know where the markets are headed, but are you venturing out on a short at all, or do you think these markets are well or better played on the longer side?
I think there's the way that, unless you see something dramatic, I'm a bit worried about as far as crude at the moment, as far as Libya. There's increasing tensions there from Turkey and Egypt, and an uncertainty across their whole tribal region. So that can create, and that can spark very quickly from I think, uncertainty and geopolitical tension. Then if you think of weather outages rolling into August with hurricanes and so on across America and rigs. So they're on that right side. On the left-hand side is, I think there's the potential, quite simply, to see softer prices from here, even with a softer US dollar because of demand destruction. So, this lockdown, if these start to ratchet up, I feel as though that you could see a softer crude price from here, Manisha. Stronger gold, crude to come off a couple of bucks. And I told you a couple of weeks ago, keep an eye on silver. It's been the standout. It performs better than its big brother.
All right. Peter, thank you so much for joining us. So Mangalam, clearly everything that you talk about, gold continues to shine there. So that is one area that you definitely have to have in your portfolio.
Yes, but this time around, perhaps we'll look at the younger brother, silver, as well, as Peter says. Manisha, thanks a lot for that. Meanwhile, just keep an eye out on the market. It is now down 90 odd points, but the decline on the Nifty is cushioned by Reliance. The Nifty Bank is lower by almost 600 points. We'll wrap up on this edition of Halftime Report. You stay tuned to CNBC TV 18 Business Lunch. We'll take the market action forward. From Rima and me, thank you for watching.